Hello and welcome to this very special episode of The Appointment. The buzz is back in the real estate sector. Yes, for the last few months we've all been hearing about how their balance sheets have been groaning and straining, but that all started changing a few weeks back when Unitech successfully concluded a $325 million QIP placement. It was done and it surprised a lot of people in the market that money could be raised. It was not a small amount of money, 1700 crores, but it was raised in the matter of just a couple of days. DLF followed with the promoter stake sale, and now some of the balance sheets clearly have been far more deleveraged compared to what it was last quarter. It all started with Unitech though, so Sanjay, Chandra, Managing Director of Unitech, is here to tell me whether now things will be on the mend, that some of the stress is beginning to be taken off the balance sheet. Sanjay, thanks for joining in. I was a bit surprised that you raised only 325 because you had a book of $1 billion. Were you not tempted to raise any more?
Actually, when we went out to raise the capital, we were looking to raise anywhere from $200 to $250 million, and that was actually what we went out and told all our investors. And the response was so large that we got demand of over $1 billion. So we discussed it with the key investors and actually finally concluded of retaining the size to about $325 million. Because that was also quite an upsize from our initial deal size.
What was it, fear of dilution? Because equity money is not easy to come by nowadays. I mean, you got a chunk on a plate, but you took only a third of it.
I think what our strategy was, which we started working on much prior to all this, we were not expecting the equity markets windows to be open, but we saw opportunity and went out and raised money in that time frame. We thought $200 to $250 million was sufficient, but we saw a demand which was far more, so we upsized it to be able to do that, because now what we are seeing is the asset sales are happening at better valuations today, because no longer we are perceived to be in distress.
Is that true? I mean, does the market, or when you talk to parties who are negotiating with, do you get the feeling that they look at you as a non-distressed party?
Definitely. Things have changed. We have started getting multiple offers for the same properties where earlier we were just getting one or two people, or that also people were quoting numbers which were very absurd. Now we are getting close to fair market value.
People don't perceive that you are in a corner anymore?
No, I think that's one thing good which came out of both the equity raise. Plus the other thing which we did was, once we realized the problems which we had, I think that was the first step towards improving things for us. We changed our business plan a lot. We started focusing, rather than land banking or from the capital intensive side, to actually banking on the land. So what we did was, there were a couple of things. You could sell land, but there are not enough land buyers today, because it's developers who buy land, and all the developers have enough land of their own, so they really wouldn't buy land. So it was the only exits which we thought of the lands would be to price our product in a manner where it sells very fast. So what we did was, we redesigned most of our product portfolio from luxury to relatively affordable to affordable, reduced the apartment sizes, reduced the prices. So in a sense, we got the ticket prices of the product which we were selling down by over 50%.
Is that right? Because the general perception is that you've reduced prices only by 15 to 25%.
No, prices we have reduced by about 25%, but we have reduced the sizes of the apartments also. So now we are catering to a far larger market size. For instance, in Gurgaon, last year, our cheapest product was 70 lakhs. Now we've got 29 lakh or 28 lakh rupee product also. So now the speed of sale in those products have been phenomenal. Last 45 days, we have booked new property residential of over 2 million square feet. Just to give you a perspective, from October to February, we would have booked only 100,000 square feet, because that's how bad things were in that period.
2 million at an average realization of?
3,000 rupees.
And this is across which geographies?
This is just NCR, just one project in Gurgaon and one in Chennai. So similarly, now we are progressively launching new products in various markets at price points where we are trying to be about 20 to 25% lower than the market prices around, as well as offering sizes which are not available in the market, which is opening a whole new customer base. So basically concentrating on creating cash out of the land.
And people are buying that? Because there is one perception that since you went through a phase of trouble, that people will not get the flats delivered on time, you will not complete projects. Are you coming across those kind of hurdles?
No. All these projects which we've launched, the 2 million square feet, when we launched it, they were at the land stage. not even a brick laid at the site. So the consumer confidence is still there. I think and all this, by the way, most of it was done before the QIP. So before we were recapitalized.
This 2 million that you're talking about?
This 2 million was sold before we were recapitalized. And post that also we are launching new projects successfully. And the key is pricing per square foot as well as the right size. So if I just reduce the prices and sell 3,000 square feet apartments, there are not enough buyers.
Do you think you will manage to deliver the kind of targets that you're talking about? 35 million of new offerings, square foot, and 20 million of new sales?
We are launching about 30 million square feet of new projects. In the last, we expect to book about 20 million square feet of that. In the last 45 days itself, we've achieved 2 million square feet, and just out of 2 markets. But every new market takes us a few months more to get established. I think what we've realized is we need to price it so that it moves. Because what it was, the example is, let's say, we all as developers were focusing earlier on the luxury market, but we had enough product that we could be a Walmart. Now we need to sell to the masses. So we need to price our product accordingly. We don't need to go after the margins. Margins will come down, but the return on equity or IRRs can be much faster with today's cost of capital.
So your focus is firmly on cash flows right now?
It's cash flow. What we want to focus on is, rather than realization per acre, cash flow per acre. We want to convert the land into really cash receivables.
How much will you end up delivering or constructing by the end of this fiscal, you think?
About 9 to 10 million square feet will be delivered this year.
You'll be able to sell it? Are you sure about that?
The bookings
of course, they
would be far more.
How much?
But this is the past product which is being delivered now. So this actually 20 million square feet which we'll book now will be delivered over the next 2.5 years.
I'm talking only about what you will book cash flow from by the end of this fiscal.
Cash flow by end of this fiscal, we should achieve anywhere from 17 to 20 million square feet of fresh bookings.
At an average realization of now?
Average realization of about 3,000.
You're sure? 18 million square feet at 3,000 rupees?
Possible, easily. I think the foundations are there. And we'll price it in a way that it does move.
And 18 million, can you give me a rough breakup between geographies? Just top of mind.
I would say about 35 to 40% would be NCR.
Okay.
15% would be Calcutta. About 30% would be South. Balance would be Bombay.
And the blended realization will be roughly 3,000.
Yeah, it'll become high because of Bombay. NCR is about 3,600. Calcutta would be about 2,500. South, Chennai has been our first initial launches in the south, where we've sold 1,200 apartments in the last 1 month. Our realization is about 3,100.
So what will your margin profile come down to?
I think margins would be still about 40%.
Even at this price?
Yeah. See, our land costs on an average is 200 rupees a square feet. Our construction cost, depending on the product, would be 13 to 1,500 rupees a square feet. So it's still healthy margins. Earlier they were very healthy.
So what will you end up this year with? I mean, in terms of, if you're talking 17, 18 million square feet at 3,000 rupees average price and 40% margin on that, what will you deliver in terms of EBITDA?
That's in future.
Sure.
Over 2.5 years.
So what will you deliver in terms of profits, you think?
I think we'll stay away from those numbers because we don't give guidance. But profitability will be down because of cost of capital, interest costs, etc. But I think the worst is behind us in terms of last 6 months. 6 months prior to, let's say, March, sales were negligible. For us as a company, for sure. And we see it from the industry also. Most of the players have been telling us that the sales were really non-existent. I think all of us took time to realize that we have to change the product also. And then post that, we have to redesign it, get it reapproved. So that process is a long one.
You spoke about asset sales. Were you just talking about ready property, or you were talking about other assets like hotels, etc., which you need to raise cash from?
It's hotels. It's some commercial office buildings. Also ready properties. In every project of ours in the past, what typically happens is it's a 500 apartment complex. You sell 450 and go on to the next project. So you have leftovers everywhere. Just that inventory is pretty substantial, and those are ready to move in. So we are concentrating on various streams. For instance, every township which we do, we have to provide for school plots, we have to provide for healthcare facilities. So all those things used to be just lying earlier, and they were not coming to use for the community or for us also. So we are selling school plots. We've sold one recently, selling some more.
Is it easy to dispose of those properties?
It is, surprisingly. We gave our first ad for it in NCR. And NCR itself, we have about 17 to 18 school plots between nursery schools, primary schools, proper schools. So just in NCR, we have 200 acres of school land. So I think it'll take us 2 or 3 years to get rid of it, but...
And hotels, how fast is it moving?
Hotels are moving pretty fast. We've sold one, and the other one also we should be close to finalizing.
Other one being?
2 hotels in Gurgaon.
By when do you think sale will be concluded?
Within this next 1 month or so.
That will net you how much?
Between the 2 hotels, we'll get about 450 crores.
But you've got a target of raising up more than 2,000 crores through
We've got
sales,
targets
right?
of about 1,600 crores for asset sales for this year.
By when?
By March.
You think you'll meet that target?
We've got about, between the hotels and one office building itself is about 1,000 crores. So that should be achieved within this quarter.
1,000 crores will come in this quarter? How much more cash do you need, Sanjay, to just breathe really easy on your balance sheet?
I think our peak debt was 10,500 crores.
Debt?
Peak debt. It became 8,500 recently, pre-QIP. Now, post-QIP, post some of these asset sales, we think we'll be able to achieve about 6,000 to 6,500 crores, which is comfortable levels, but we still intend to take it down to about 4,500 to 5,000.
That's still quite high. I mean, you would still have a fairly significant interest payment going every
Yeah, interest costs are also coming down for us.
How much is it now? Still close to 1,000 crores?
It was 1,000 pre all that. I think average blended for this year would be about 750 to 800 crores.
That would drink up a lot of your cash flows. You need to reduce it further, right?
No, I think what we are seeing is the surplus cash flow which we'll be generating would be about 1,800 to 1,900 crores.
This year?
This year.
Okay.
So out of that, let's say, this is after the interest. So we can reduce our debt further by 1,700 to 1,800 crores this year.
Oh, you're saying after paying 800 crores of interest, you will generate 1,800 crores of net cash flow? You're sure about that?
Very confident on that.
So you don't need to dilute any more equity?
No equity dilution needed at all. I think what we need to concentrate on as a company is to launch affordable projects which move fast. I think the best thing for us to do is to bank on the land which we created.